Picture two businesses on the same road. One is a small shop, run by someone about your age, turning over £50,000 a year. Between income tax, national insurance and corporation tax, that owner hands over close to £12,000. Across the street, a multinational chain reports the exact same profit on the exact same turnover. Same road, same year, same £50,000. Their bill comes to under £2,000. That gap is not a rounding error, and it is not an accident. Across the whole country, the tax that should be collected but never turns up adds up to £46.8 billion a year. HMRC wants you to believe that 60% of that gap is caused by people like the shop owner across the road from that multinational chain. That is the part that should make you sit up. Stay with me, because I am going to show you why that 60% figure is not the whole story, what it actually means for the retirement income you are counting on, and how you make sure you are never the one who gets blamed for a gap you did not create. If you run a small business, let out a property, or you are simply trying to reach retirement without HMRC knocking on your door for the wrong reasons, this one is for you. Sarah is 58. She spent 30 years teaching before she retired, and these days she runs a small online shop from her spare room, bringing in about £35,000 a year. She thought her tax affairs were about as simple as they get, right up until an HMRC compliance check landed over one small entry on her return. Here is the number that matters. The tax gap for the country sits at £46.8 billion, which works out to about 5.3% of all the tax that should have been collected. HMRC's own figures say 60% of that, £28 billion, comes from small businesses just like Sarah's. Say that number out loud and it sounds like an army of small traders quietly dodging the system. Except when you look at what actually makes up that 60%, the picture shifts. HMRC's own random checks found errors in 53% of small company returns and in 43% of self-assessment returns from small business owners. The single biggest reason behind the gap is not people hiding money. It is people failing to take enough care with paperwork that gets more complicated every year, with straightforward mistakes close behind. Deliberate evasion sits well behind both of those. I have seen this play out with people who never once tried to bend a rule and still ended up defending themselves for weeks over an honest slip. Sarah's mistake was not cunning. It was the kind of small error that happens when you are running a business on your own, doing your best with rules that change every April. So why does HMRC still put a number this precise on a group this hard to measure? Even the people responsible for checking HMRC's own working have flagged the limits here. The random checks that feed this figure take years to complete, so the two most recent years are not even finished yet, and the checks only look at businesses HMRC already knows about. They cannot count the ones that have never registered at all. That is not a solid scorecard on people like Sarah. That is an estimate with real gaps in it, presented with more confidence than the method can actually support. Here is the trade-off nobody puts on a slide. A small trader who has under-declared a few £100s is quick and cheap to chase. A multinational using layered ownership and cross-border royalty payments takes years and a team of specialist lawyers to challenge properly. HMRC has to show results every year, and a stack of quick, easy cases looks better in an annual report than one unfinished court case against an accountancy firm's finest. That is the trade-off hiding underneath the headline number. If nothing changes, the cost is not abstract. Every pound spent chasing small, cheap cases is a pound not spent recovering the far larger sums sitting inside structures built specifically to move profit somewhere the bill is lower. The gap does not close. It just keeps landing on the same people. If you are a small business owner, a landlord with one flat, or a retiree topping up your pension with a bit of self-employed income, you are not a tax dodger. You are the easiest name on the list, not the biggest problem on the balance sheet. £28 billion is more than the entire health budget for Scotland in a year. Sit with that for a second, then ask yourself whether an honest mistake on a return like Sarah's is really where a number that size is coming from. The real avoidance problem is not sitting behind a shop counter. It is sitting inside debt-loading arrangements and royalty payments designed to move profit to wherever the bill is smallest, and UK tax rules make that easier to do than most people realize. Let me show you what that actually costs you. I used to think the tax gap was entirely a story about big corporations hiding money offshore. Then I actually read through how HMRC builds that 60% figure, and I realized the real story is different. It is a stretched agency putting a confident number on a group that is genuinely hard to measure, because chasing small business is administratively easier than chasing the structures doing the most damage. I was wrong to assume the number was as solid as it sounds, and I suspect a lot of people watching this have made the same assumption without ever checking it. Here is why this matters for your retirement, not just your sense of fairness. 3 numbers are worth holding on to because each one lands somewhere close to your own household, whether or not you have ever run a business. The first is the gap itself, £46.8 billion. If even a tenth of that were properly recovered, roughly £4.7 billion, and channeled toward the state pension, spread across the 9.4 million people already drawing it, that works out to something in the region of £500 a year each. Call it about £42 a month, roughly a week's food shop. That is not a promise, and no government has committed to doing this. It is a way of showing you the scale of what is being left on the table, and why it is worth caring about beyond your own tax return. The second number is what an HMRC compliance check can cost you directly, whether or not you have done anything wrong. Even a straightforward inquiry can easily reach £2,000 once you add up your time and any accountant's fees to prove your innocence. Sarah's own bill, just to demonstrate that her mistake was innocent, came to £1,200. That is money spent defending yourself against a system that already lets the far bigger fish swim past it, and it is money that comes straight out of the same pot you were planning to retire on. The third number is the one most people leave sitting on the table without even meaning to. Pension tax relief. Depending on your income, you can get up to 45% relief on what you pay into a pension, which is effectively free money added by the government every time you contribute. Plenty of people near retirement are still under-contributing, quietly leaving hundreds of pounds of that relief unclaimed every single year. Left unclaimed for long enough, that is not a small gap. It is a quieter, slower version of the same problem, and it shows up years later as a smaller pension than it should have been, at exactly the point when you have the least room left to fix it. For context right now, the full new state pension for the current tax year sits at £241.30 a week, which comes to £12,548 a year. That is the baseline a lot of people your age are building the rest of their retirement income around, which is exactly why an extra few £100 a year from a properly funded system, or an extra few £100 a year from unclaimed pension relief, is not a small thing to either of you. So how do you make sure you are never the small business that gets the blame, without pretending the rules do not apply to you? It is not about hiding income or getting clever with your paperwork. It is about making the system that already exists work in your favor, properly and visibly, the same way it already works quietly, in favor of people who know where to look. That is what I want to walk you through next. Sarah thought she was doing everything right. She used a free bit of software to file her return, kept receipts in a shoebox the way she always had, and assumed that was enough. Then the compliance check landed, and she spent weeks pulling together records to prove a single entry was an honest mistake. It cost her £1,200 in accountant's fees just to close the file. You do not want to be Sarah, and the good news is you do not have to be. Start with your records. If you are self-employed or you let out property with turnover above £50,000, making tax digital is no longer optional. Your bookkeeping needs to be kept digitally, with returns sent to HMRC through compatible software rather than a spreadsheet patched together every April. This is not about buying anything expensive. It is about treating your paperwork the way you would treat a boiler service, done properly, on a schedule, before it becomes a crisis. Next, get a second pair of eyes on your tax return. A chartered accountant with small business experience typically costs somewhere between £300 and £500 a year. And that fee is small change next to what a poorly handled compliance check can cost you in time, stress and fees to sort out afterwards. Think of it less as an expense and more as insurance against being the next Sarah. Then look at your pension contributions properly, ideally once a year rather than never. That up to 45% tax relief only shows up if you actually put money in, and plenty of people near retirement have room left in their allowance that they have simply never used. A conversation with a qualified advisor about whether you are using that allowance fully can be worth far more than the time it takes. Finally, use the tax-free allowances that already belong to you. Your ISA allowance covers £20,000 a year, completely free of tax on any growth. Your capital gains allowance covers the first £3,000 of gains each year before anything is due. And if you are married or in a civil partnership and one of you earns less than the personal allowance, the marriage allowance can transfer up to £1,260 of unused allowance to your partner, straight off their tax bill. None of this is a loophole. It is simply the system doing what it was built to do, if you actually use it. If you want to keep your retirement protected from unfair tax checks and make sure you are claiming everything you are legally entitled to, hit subscribe. I will keep showing you how the system actually works, and how to stay on the right side of it without leaving money behind. Even with every record filed and every allowance claimed, it can still feel like the system is rigged against you and not against the people with the resources to fight back. Why does HMRC end up auditing a 58-year-old former teacher over a shoebox of receipts, and not the multinational with the layered ownership structure? That feeling deserves its own conversation. You have seen the numbers now. You know the 60% figure is shakier than it sounds, and you might be feeling something between frustration and quiet anger, maybe even a bit of shame that you have always paid what you owed, while some seems to get away with more. It is called the just world fallacy. We want to believe that if we play by the rules, the system will treat us fairly in return. It is a comforting idea. It is also not how a stretched tax authority actually allocates its time, and knowing that does not make the feeling disappear. It is completely normal to feel a bit betrayed by that. You have worked for decades, paid what was asked of you, and now you are looking at evidence that the burden keeps drifting toward the people who are easiest to check, not the people who owe the most. That is not a flaw in you. It is a design problem in how compliance gets prioritized, and it has nothing to do with how carefully you have lived your working life. I went through an HMRC compliance check myself a few years back, over something that turned out to be entirely innocent. I remember the specific feeling of lying awake, wondering whether a mistake I did not even know I had made was about to cost me thousands of pounds. It is unsettling in a way that is hard to explain to someone who has not been through it, and it does not matter how organized you normally are, the letter still lands the same way. What got me through it was not luck. It was having my records in order and knowing exactly where I stood, so the conversation with HMRC had somewhere solid to land instead of turning into weeks of guessing. Here is the one shift worth making. You cannot control how HMRC allocates its compliance checks, and you cannot control which structures a future government decides to close down. What you can control is your own paperwork, your own allowances, and your own pension contributions. Every legitimate pound you keep through proper planning is a pound the system cannot take from you by accident, and a pound you are not relying on a headline statistic to protect. That is not tax avoidance in the way the news uses the word. That is simply retirement planning done properly, quietly, in the background, while the argument about who owes what continues without you. Let's bring this together. HMRC says small business causes 60% of the tax gap. Look closely at how that figure is built. and most of it comes from honest mistakes and paperwork under pressure, not deliberate evasion, measured with a method that even its own auditors admit has real gaps. The number that should actually hold your attention is £46.8 billion, because a fraction of that properly recovered could mean real money for the state pension so many of us are relying on. And the best protection you have is the boring stuff done well. Clean digital records, a decent accountant, full pension contributions, and every allowance you are entitled to actually claimed. You are not the problem here. You are the person who pays what is owed, keeps a small business or a rental property running, and wants a system that treats you fairly in return. That is exactly why staying informed is worth your time. If you are a small business owner, a landlord, or anyone heading toward retirement who does not want to be the easy target in a system chasing easy numbers, hit subscribe. I will be here to help you make sense of the UK tax system, one honest number at a time. This is Arthur's UK Retirement Guide, where we make sense of the money that actually matters to you. See you next time.